Welcome everyone to this month's webinar. It's great to see everybody. I know most people here know who I am and what I do, but just to cover my basis, I am Bruce Rosenblatt. I own Senior Housing Solutions, and I provide expert advice for people who are thinking and considering senior housing either immediately or in the future. So I've been doing this for over 30 years, and this coming June, and about a week from now, my company will be on its 13th year anniversary, which is pretty phenomenal. So it's great to see everybody. And again, I also, as a resource to people in the area, I try to educate people about the different things. And I would say, throughout my discussions with people, I get a lot of questions about long-term care insurance, and I because I've been doing this for so long, I can fumble through it. But I felt it's better to talk to an expert, and I've known Mitchell Dannenberg for probably for a good 20 years. Great guy, very knowledgeable, and so there are many times where I will, talk to Mitchell about a policy and get his insight about different, the ins and outs of the different policies. But I thought for today, it'd be great to let Mitchell share with us some of his insights and some of his wisdom about long-term care insurance. If you all have specific questions, if you want to hold us off until the very end, and Mitchell, I'm going to let you take it from here.
Terrific. Well, Bruce, thank you for inviting me to your event. I appreciate it. And I welcome being a helpful resource for your friends and clients that have decided or opted to participate today. So we are an independent insurance brokerage, and we have a long history with long-term care planning. And so what I want to I'm going to jump right into long-term care initially, and then we'll come back and touch on some other areas. But for those of you who have long-term care coverage, pat yourself on the back. Good for you, congratulations, and thank you for taking that step. It's important to help you, give you freedom of choice, to help you preserve your assets if a need for care arises, depending upon what you Google, what data you look at. Simply by virtue of turning 65, there is a 70% chance that you will need at least 1 year of care. My mom is 90, and my mom bought a long-term care policy before I was in the business. And she's been on claim 3 separate times. And her John Hancock policy has been absolutely spectacular. Now, I'll add that John Hancock is no longer writing new coverage. Many, many companies have left the long-term care arena because they just did not have a good grasp on what the morbidity rates or how long people would live, and if or when they would become sick, or if or when they would need assistance. Life insurance companies, who typically are the issuer of these policies, they understand when people are going to potentially pass away. So many of them have said, wait, our claims experience has gotten a little bit out of hand. Many of you who have these policies may even have experienced a rate increase, sometimes of 5 or 10%. In my own case, I have a policy through MedAmerica. I had an 86% rate increase, but I also know that I need this protection. And so I paid the rate increase. All right. So with that shared, I would just tell you this, that if you are in a community, then you want to absolutely keep your policy. If you are looking to be in a community, you absolutely want to keep your policy. My mom moved into a community, and for a little bit over 2 years, while she was living in independent living, we were bringing care in probably 6 to 8 hours a week for mom, just to help out around the house. And after a couple of years of that, mom transitioned into assisted living. And her policy is paying 100% of her assisted living invoice. And before that, they were paying 100% of the care when she was in independent living. And in her community, she had a rent of roughly, I want to say about $3,500, $3,600 a month on top of her buy-in fee that she paid. And then when she transitioned to assisted living, that monthly rent, so to speak, or fee went up quite a bit. But again, she had this long-term care policy. What I'm going to share with you is I'm going to give you a couple of little nuggets, so to speak. I find a lot of times clients who have a long-term care policy are reluctant to file a claim. And I'm going to share with you, don't be reluctant. You've been paying premiums. Let the insurance company help you. There is typically a fair amount of paperwork that needs to be executed to file a claim, but it begins with a phone call, typically to their 800 number. And they will then typically contract with a third party who will come out and do a face-to-face assessment interview. They may request medical records from your primary care physician or other doctors that you might see. And the reason I say file a claim as soon as possible is that typically most policies have a 30, 60, 90-day or longer, what's called an elimination period. Think of it really as a deductible, like you would have a deductible on your homeowner's policy or your auto policy. First $1,000 you pay, first $10,000 you pay. By filing a claim sooner, when let's say you only need 2 hours of care 3 days a week, and let's just say that the cost of that care for discussion purposes is $25 an hour, you're paying $50 a day, 3 days a week, $150. So in order to get through after roughly, give or take 3 months, you will have met your 90-day elimination. And you'll have done it for just literally, under $5,000. Versus if you wait until you're in assisted living or you need more than 2 hours of care, you're still going to have to outlay the money for the first 90 days. So instead of $150, you are paying, let's say $200 a day. It's now going to cost you about $18,000 to get through that 90-day window until the company starts to pay. All right. I'll also add that the companies do want to pay your claim. All right. And we have helped people file their paperwork. A lot of times children are out of town or children are busy or candidly, mom, dad, and or the kids have no idea where to start. And we've helped a number of people with filing their initial claim. In addition to that, what I can share with you is long-term care policies typically are based upon activities of daily living or ADLs. And Bruce, thank you for switching the slide. And so you can see here, they are bathing, continence, dressing, eating, toileting, transferring, or mobility. With most policies, there's an automatic trigger if you are diagnosed with Alzheimer's or dementia, and you're taking Numenda and Aricept, you're seeing a neurologist, a psychologist, and or there's an actual diagnosis. So that would trigger your policy. For some of you that bought your policies a long time ago, if it's after 1996, policies will cover most typically care while you're in your home, adult daycare, and assisted living and skilled care and memory care. If they're before 1996, they may be quote unquote nursing home only policies, which means you need to be in skilled care. All right. And the other item is these policies come with different riders. And we had a client last year who we worked with about 11 or 12 years ago, and his wife took sick from cancer and passed away. And he didn't realize it, but we put a survivorship rider on that plan because they were fairly young when they bought it. When I say fairly young, they were in their early 60s. And we felt that there was a pretty good chance they were going to live at least 10 years. And the beauty of what they did, and this happened to be a Genworth policy, is when Michael's wife passed away, both his policy became paid up in full, no future premiums, and he inherited the 4 years his wife had. So he now has 8 years of coverage with no premiums and 5% inflation protection. His policy just keeps growing every year, and he's not paying anything for it, and he never will again. All right. And sometimes folks don't realize this. There are other riders, for example, that if you do have a spouse or domestic partner and you have a joint policy and one of you is on claim, very often the healthier of the two of you will not have to pay any premiums as long as that other person is receiving a benefit or on claim. All right. There are also things like restoration of benefits. If you've been on claim, like my mom was, she fell and broke a hip about 10 years ago. She opted, or I should say we opted candidly, to give mom a live-in caregiver. And over that 6-month time period, mom ran up close to $60,000 of fees for the caregiver to move in. And the beauty of that is that once we got through the elimination period, her monthly costs were recovered in full. Right? What we did do for my mom, and I've done this for other people who have very robust coverage, we made a decision a couple of years back to, when mom was still paying her premium, okay, this is not after she was on claim, but mom had a 5% inflation rider. And we ran the numbers and said, you know, I don't think mom needs this anymore. And so we dropped the inflation rider and it lowered her premium. And mom still has, you know, probably $1 million inside of her John Hancock policy. And John Hancock has laid out over $200,000 for her care. And she paid a fraction of that in premiums. So we're always glad to review your long-term care policies so that if you've got questions, we're happy to walk you through. We find a lot of times that folks bought a policy 5, 10, 15, 20 years ago and just don't really recall or understand the ins and outs of their policy. All right. But again, with the activities of daily living, we had the slide up of the 6 of those, the plus the Alzheimer's and dementia. You're going to need, with most policies, to have 2 of the 6 that you need assistance with. And we've had clients that have a very high quality of life. They may have a continence issue and or a mobility issue where they're working with or walking with a walker or four-pronged cane. But other than that, they're still driving, they're sharp, and they're collecting a benefit from their policy. Right? And so it's not as if, sometimes I'll have people say to me, "Oh, Mitchell, if I need care, it's not going to be a good situation." And I'll just share with you again, not unlike Bruce shares. Better to be a 5 years too early in filing your claim with the insurance company than a day too late. Because again, this is money that is coming out of your pockets. All right. The other thing I'll share is that for those of you who may not have a policy, depending upon how you want to plan your age, your health history, there are policies and plans out there that can provide for care as long as you're not currently receiving care. And some of these are service contracts. They're not really insurance. There's a company called True Freedom that offers a service contract that provides for care. Certain number of hours per year, you pay a flat fee. They negotiate with a variety of vendors to bring you a caregiver, and it doesn't cost you anything out of pocket. All right. And they come in different tiers as far as numbers of hours. Then there's the more conventional long-term care policy, which pays so much per day or so much per month for 2 years, 3 years, 4 years. There are life policies, and I mean life insurance policies that have spend down provisions in the event someone needs care. And you may have a life policy that will give you dollars for care. So if you've got life insurance, I would share this with you. It's important to review that, not only to find out, is there a rider if you have a permanent or temporary need for care, instead of spending, because with different families, they're like, Mitchell, we're going to write a check for care, and we're going to let the life insurance flow, to either my husband or my wife or the kids or grandkids. It's better for us to write a check. Great. And then there are other folks who are like, no, let's leave the investment portfolio intact and use the life insurance policy. And the reason I talk about policy reviews being so important is, let's say you may have a life insurance policy. You bought it 15, 20 years ago when interest rates were much higher. And what's important with that is by getting what's called an in-force illustration. We recently had a client who bought a policy about 17 years ago and was paying about, a small policy, $200,000, and paying about $220 a month for it. And it was supposed to run until Glenn was age 100, which he felt comfortable with. We got an in-force illustration. He is now 74. And it turned out, because of changes in interest rates and policy performance, his policy was going to lapse at age 76. And if he wanted to keep it in force until age 85, the company wanted an additional $400 per month. And so we ended up replacing his coverage with a $100,000 policy because his needs had changed. And it's guaranteed out to age 121. Not that he ever anticipates even seeing age 100. But he felt more comfortable, and I felt more comfortable creating a solution for him that we knew no matter what would pay a death benefit. And again, these are areas that we can help with. The other area that we are helping folks with is Medicare. And we find that a lot of folks have a Plan F. And I love Plan F. It's a zero deductible. It's terrific. All right. But we've been finding with a number of our clients who had Plan F that we can move them to a Plan G, which has a $203 deductible. But what it does is, in exchange for paying that deductible, it will very often save them between $400 and $600 on their annual premium. So if there's two of you, you might save $1,000 to $1,200 in exchange for having a $203 deductible. By no means am I advocating, oh, wait, you've got to change your plan. It's just a case of knowing what's out there. The other area where a lot of savings can be generated is very often folks will buy a Part D drug plan with Medicare. And then their prescriptions change over time. But they've not looked at their Part D drug plan in 1 year, 3 years, 5 years. Mitchell, it covers what I need it to cover. And we have found that by reviewing the Part D drug plans and such, that again, we can create some fairly substantial savings on those drugs that one might be taking. We have a client, and we've got clients across the country in Dallas that purchased a Part D drug plan from us or through us. And at the time, he was taking a statin and a blood pressure medicine. And then about 5 months after he became Medicare eligible, he was diagnosed with AFib, and he started needing Eliquis. And his current Part D plan would not cover the Eliquis. And so he was paying out of pocket roughly $460 a month to get Eliquis. And he could afford to do that. And he wasn't that worried, but he said, Mitchell, when we come around to open enrollment this coming year in 2021, let's make sure we get a plan that'll cover the Eliquis for me if we can. So again, we're here to help. We're here to be a resource. I invite you to reach out to us. You're welcome to give us a call. And
Mitchell, I have a couple questions for you that might help.
Okay,
prompt you.
please.
So will you talk a little bit about, maximum benefit versus daily benefit? Because I know there's some policies that have, unlimited or have a daily benefit.
So again, depending upon how your coverage is written, when it was purchased, there are two kinds of, well, there really are more than two kinds of benefits or riders. One is an indemnity policy. I personally have an indemnity policy. It will pay me a lump sum of money directly into my checking account each and every month that I'm on claim for a period of 4 years. It will continue to grow with inflation during that time, even though the company is paying me out. All right. Now, I can take that money and spend it any way I want. If I want a new flat screen TV, if I want to take a cruise, I can do that. All right. Other plans, and more typically, are reimbursement. And reimbursement means you're going to need to use an agency or a registry to bring in professional help. All right. And when I say professional help, I mean just through one of these entities in order to qualify to get reimbursed. And then you would take those invoices that you receive from whomever your agency or registry is, and then you would send them or upload them electronically to whomever your carrier is. Sometimes the agencies will bill the long-term care companies directly on your behalf. And then they'll just send you a copy of what they've billed for X number of hours, et cetera. The other big question is that, again, we like to try and answer for folks is, do you have a daily benefit or a monthly benefit? And a daily benefit might be, let's just say $200 a day. But it's more advantageous if you happen to have a monthly benefit because it would give you $6,000. So let's just say you or your loved one are on claim and one of you is healthy and says, I want to go visit the kids for 2 weeks, but I want you to have somebody here 8 hours a day while I'm gone. Okay. That's going to cost more potentially than the $200 per day. Having the $6,000 lump sum, or let's say I'm going away for a week and I want you to have more care, I'm not going to be able to check in on you. You're going to have that full $6,000 available to you even for just a week of care versus a day of care at $200 per day. So, Bruce, does that answer?
Well, I just want to kind of, I guess, go a little bit further because there's daily benefit, but then there are policies that have a maximum benefit. So you might have a daily benefit of $200 a day, but your policy might have a max benefit of just say $200,000. And so that's really what I wanted you to talk about.
All right. So with maximum benefits, what you have purchased when you've purchased a long-term care policy is a pool of money. In essence, like Bruce alluded to, $200,000 to be outlaid over 2 years, 3 years, 4 years at $200 per day. Plus, if it has 5% inflation, whatever that benefit has grown to over time, let's say it was an initial $200,000 benefit. Maybe over 15 years, it's grown to 400,000, right? And now instead of 200, you've got $400 per day or $12,000 per month for care. But you're going to have what's called a pool of money to spend down for your care. Does that help, Bruce?
It does. All right. So my next question, there are assisted livings that have a base rent and then you pay for levels of care. So you might pay $3,000 for your base assisted living, but then you might be a level 2 or a level 3, and so you're paying additional for your care. So when you file a claim, are you filing it for rent and care, or are you just filing it for the care portion?
You are filing for rent and care. I mean, assisted living, like, for example, my mom receives an invoice for her rent, and then she is at a level 1 care. In addition, she's getting medication management. So that's an extra $500 on top of her monthly rent. All right. She's receiving, because under Florida law, you need to have 3 meals a day. Okay. Instead of when mom was in independent living, she had 1 meal a day. All right. So there's an extra $500 monthly charge for 2 additional meals. All right. John Hancock is paying all of that. They're paying the additional meals. They're paying the level of care fee. They're paying the rent. And it's all encompassed. What they're not covering is mom has laundry service for $81 a month. They're not going to cover that.
Okay. And I know you touched on this, but I just want to be clear. So if somebody has a daughter and that daughter is providing assistance for somebody in their own home, like for their parent, or if it's not a daughter, maybe they've hired somebody from Publix to help them out in their house as a private duty person. Can that be considered a qualified person?
It cannot. Under most policies, again, you need to use an agency or registry. And I'll share this with you that you really want to, because you then have some liability protection. Let's say you have we worked with a family a number of years ago, lived in Naples, and very comfortable financially. And the husband took ill, developed Parkinson's, and actually actually ended up ultimately needing a caregiver pretty much full time. The family had a housekeeper. The housekeeper had a sister. And the two girls agreed to come in and work with this gentleman's wife and say, look, between the two of us, we'll be here 24 hours a day. We'll do the housekeeping. We'll help you prepare meals. We'll take care of your husband. And they had, it just happens to be a Genworth policy. And they filed their paperwork to collect on the policy. Genworth kept denying the claim. And I was brought in to speak to the family by the wealth advisor, said, Mitchell, can you please just help them untangle this? And the wife said, Mitchell, I don't understand. I'm sending them, copies of checks and, withdrawal statements from the bank, and Genworth isn't reimbursing us. And I said, you're not using a licensed caregiver. I said, the other issue is God forbid, one of these women was, let's say, helping your husband move from, a chair to the couch or back to his bedroom, and he falls on them, and that individual gets hurt. They can file a suit against you for workers' comp claim. When you have an agency or a registry, you've got protections, and these companies all have umbrella liability policies. If a watch, some of us might have an expensive watch, a diamond bracelet, other things in our home, if those things go missing, you've got a source to go back to and say, hey, wait a minute, we can't find such and such.
Okay, good point. So my next question is that, like, and you used your mom as this example. So with your mom, when she broke her hip and you filed a claim, so she went through let's just say it was a 90-day deductible period. Her hip got better, and now she's, maybe she's still in assisted living, but she doesn't need any extra help. But then something else happens down the road. Does she have to go through another deductible period?
Typically not.
Once you go through that deductible period, that's it?
With most policies, correct. Once you meet the deductible, it's a lifetime deductible. With some older policies, they require a new deductible every time. Again, that's one of those, let's take a look at your policy. Because what I do is I encourage folks to look, not everyone is always liquid with their assets. They're invested, they're tied up somewhere. And I say, folks, look, let's make sure you're going to have relatively easy access to what 90 days of care might cost. So you don't have to worry about it. You've got this on hand before the insurance company begins to send you checks.
Okay. So this is sort of a follow-up question to that. If I was living at home and I had assisted living, or I had home care, and so I started my my claim, and so I was working through my deductible period, and so now now the long-term care insurance is paying for my home care living in my house. Well, I talked to Bruce, and Bruce says it's time to move to assisted living. And so now I move over to assisted living. Can I use that time that I got approved for the home care and use it over in the assisted living? Or do I need to start that claim process again?
Typically, you do not need to start that claim process again. You have met your elimination period. You're just shifting to a new opportunity for delivery of care. All right. Okay. One thing I do want to touch on is most policies are what are called single payer type policies. In my mom's situation, they're covering her level of care addition, they're covering her additional meals, they're covering her rent. His mom has declined, and she's still very sharp and with it, all things considered. We're bringing care in for mom 4 hours a week, just to, help mom just keep her apartment a little bit cleaner and more organized, make sure there's no food in the fridge that needs to be thrown away. Although her community, the staff there does a pretty good job of staying on top of that stuff. Her John Hancock policy will not pay for that. All right. They would pay either for care or the assisted living and all the add-ons. They won't pay for home care in an assisted living scenario, unless if you have an indemnity type policy that would pay you cash, then yes, you can use a son, daughter, granddaughter, as Bruce mentioned, somebody from Publix. But again, just be aware of when you're not working with professionals, they don't have necessarily, they may be wonderful people. They just may not have the training. And this one couple that I had mentioned earlier in our conversation, I said to mom, I said, is your family attorney aware that you've got these two women here helping your husband? And her comment was, well, why would I tell them that? It doesn't matter. And I said, please call the attorney. And the attorney immediately said they need to exit the house immediately, as soon as possible. Instead, I came up with through an agency in town, I had the two girls hired by the agency within a week. And then the agency began actually invoicing. It became official care, and Genworth began to pay the claim. So again, these are just areas where I can be of help to you.
So Mitchell, so many of these people who are on this call today, bought their policy 20 years ago. And 20 years ago, there wasn't such a thing called assisted living. There might have been convalescent care, but there wasn't, assisted living really didn't exist. Many, when a lot of these people bought their policies. So how do you go about, now that the terminology has changed and the type of living arrangements have changed, how do you go about talking to your insurance company saying, hey, my policy says convalescent care, but there isn't such a thing as convalescent care. Now they call it assisted living. So what should
that is going to be, Bruce, and to everyone else, that's going to be on an individual policy type basis. All right. Most policies, because there are new forms and modalities of care being delivered. I mean, I dare say memory care is a newer concept, not unlike assisted living is a newer, when I say newer, within the last probably 15 years, give or take. Used to be when my grandmother passed away in 1980, she went to a nursing home after her stroke, and that was it. And it was a nursing home. Now, I mean, if it would have happened today, my grandmother probably would have gone through rehab and transition and been in assisted living for, her life. But what that takes is, as we're reviewing a policy, we might get on the phone to whomever the insurer is and say, look, there's some language here. We just would like you to please confirm what this policy would pay for. And can you please give us an in-force illustration? Because with most policies, let's say it was bought 20 years ago and the benefit was $150 a day. In most policies, there's not an inflation adjusted chart that shows in 15 or 20 years the growth in your benefit. Now, most companies send an annual policy statement that says, hey, your benefit, your premium has not gone up. Your daily or monthly benefit is now blank amount. It used to be this amount. But I'll also share this with you. I hope our fire alarm does not go off, and I apologize if it does. It's been going off all morning. there's just, there's a lot of ins and outs, like getting that, when someone gets that annual policy statement, very often, if I mention, oh yeah, I got it in the mail. I said, do you understand? We just dropped it in the file. And I would just encourage you, because when you're in the midst of that emotional upheaval of filing a claim, and whether you're fortunate enough to have a spouse, partner, or a good relationship with your children, it's really helpful if you've got a resource that can kind of help guide the process, and just letting the kids know, hey, look, we have a policy. It's in our Century Fire Safe. It's in our safe deposit box, or hey, we're sending you a copy of it so that you know that we've got some protection, kind of thing.
So I got a call the other day from this gentleman who moved into a rental independent living senior community, and he was fit to be tied because obviously he didn't use my services, but he was fit to be tied because he said when he went there, the salesperson said, oh, well, you have a long-term care policy. We'll help you with your long-term care policy, and that will help pay for your rent. And he was so upset because he moved in independent living and he didn't need any of those ADLs. And so, he was pretty much out on his own paying for his rent. And so, Mitchell, don't you think it's advisable that before somebody moves, that they look at their long-term care policy to see what it covers and how it gets activated?
Absolutely. Absolutely, Bruce. Just because it's, again, as I've mentioned, it's, when you're in the throes of the upheaval, you want your application to be approved. You want it to be accepted. You want the money to start flowing. And if you're not that concerned about it, I'll just share this with you. Your kids will be. All right. And I don't mean to be disrespectful when I say that, but I've worked with a variety of families. And sometimes there's a long-term care insurance policy and other times there isn't. And they're coming to me, I'm Mitchell, what can we do? And the kids are worried, gosh, Joe is spending $100,000 a year on care. Care for 5 years, he's going to spend more than half of his resources. And the reality is, I dare say, they are less concerned about Uncle Joe spending through his resources and more concerned about what their inheritance might become. And again, I don't mean to be disrespectful to anyone, but I have been witness and sat across from sons and daughters who don't want to spend the money on care. No, we're not going to do round the clock care. We're going to do, 4 hours in the morning, 4 hours at night. When you have a policy and you understand how it pays and how it triggers, boy, let your loved ones know you've got it, because they will use it. They will use it.
So you've done a good job. I try to throw you off on some of my questions, Mitchell. So I'm going to open it up, see if anybody else has any questions. Yes, Barry, hold on. Let me unmute you. Hold on. Go ahead.
He's muted.
Yeah. You got to take.
Hi, Mitchell. Can you hear me?
I can, Barry.
Good. I had a question. Thank you for all that information. I was wondering, is there kind of I mean, I think the answer is probably going to be as early as possible, but is there a kind of sweet spot or a cut-off point on someone's age with regards to buying one of these policies or investing? Is there a tipping point where it makes more sense versus less sense? Is there a kind of age for that?
Sure. I mean, here's what I'll share. The younger and healthier we are, the more affordable coverage will be and the more options that you have. All right. I would encourage you, if this is something that you or someone you know is thinking about, let's begin to explore what it is you're trying to achieve in that. Let's say this is, for yourself, and you've got a couple of, you've got a spouse, partner, children, grandchildren. It's like, look, it's important to us that we leave X amount of money to the kids. Right? So we can build a plan that not only offers you care, but potentially if you don't use that plan, there will still be a benefit, a death benefit, something like that. I mean, one of the things I want to stress is conventional long-term care policies. If just like your homeowners or your auto insurance, if you do not use your benefit or whatever percentage or amount of your benefit you do not use, you don't get that refunded to you. All right, it's gone. If I don't have an auto accident, I don't get any of my any payments from Progressive. The beauty, and we've seen about 80% of our market shift to what are called hybrid policies that offer a death benefit and a long-term care benefit. And these are available in many, many different flavors, so to speak. You can pay lump sum, write a check for $100,000 to Lincoln Money Guard, and you'll get $150,000 death benefit, and you'll get $300,000 for care. All right. There are also policies where, like with Mass Mutual, you don't have to pay a lump sum, and you can buy a $250,000 policy. It'll give you $9,000 a month for care, and you're going to pay $8,000 a year for that, just to make up a number. All right. Beauty of that is that over time, that $250,000 policy, let's say you live another 30 years, it'll probably grow to be $500,000 in death benefit. And instead of having 24 months of care at $9,000 a month, you'll end up with 48 months at $9,000. And then you can use your Social Security, 401k, or IRA drawdowns or other monies to augment the additional costs for care. But Barry, what I would just share with you is, just like Bruce speaks of for his clients, you want to do this sooner, because I've had clients say, Mitchell, gosh, if I just took that blank amount every year and set aside, in 20 years, I'll have a good chunk of money. Well, my experience is people don't set the money aside, and no one knows when our health is going to change. And so it's better to own some protection, because until you do, all of us who don't have some kind of plan or actually do have a plan. And what you're doing is you're saying, we're going to self-fund. I'm just going to spend my money down. And my experience is once that spend down begins, then there's angst.
We have a question. Thank you. So we have a question. The question is, we have two policies with different companies with different elimination periods. How do we manage that?
Well, depending upon who is healthier or who needs care first, you would, let's say one of the two goes on claim. All right. Again, depending upon the policy language and how it reimburses, or what monies it provides, you would choose, okay, wait, we're going to file a claim on this policy. All right. If both people needed care, you may want to hold off on filing a joint policy claim so as to stretch the dollars out for a longer period of time. But again, it's important to understand how each policy works independently, because they're not going to be linked if they're from two different companies.
Okay. Dudley, great to see you. I know you have a couple questions.
Thanks, Bruce. I have one of general interest and then one of more specific. The general interest is, we've had a Genworth policy since 2001. Our next door neighbors do also, and they have just filed for benefits, and they've been at it now for 5 months. They tell me that it's the worst experience they've ever had. The lady filing is extremely good with detail. She used to be a doctor, and she says it seems to her they do everything possible not to pay if they can. They haven't told her all the forms she needed to fill out. She fills out one, then they say she needs another, but they didn't tell her she needed another. Then she's finally got all the forms in. Then she files the claims with all the detail necessary. Then she waits and waits and waits. Then she calls. She says she normally has to call 4 to 5 times before a check arrives. We all know that these policies are not profitable, especially the old ones with the 5% increases. Are you finding this true to be of many companies or Genworth, or does this sound familiar?
I've heard of these situations, and I've had individuals and families reach out to me. We had a client who lived in Miramar Lakes. Her husband fell and had a head injury and needed care, and she was trying to deliver as much care as possible, but had a caregiver come in. And she happened to have, it was a John Hancock policy. And she was like, Mitchell, I've called these people. You know, they send me forms. I'm not sure how to fill them out. We worked with Janice on behalf of her husband Art's policy. And we were able to get this rectified within about 5 hours of the two of us being on the phone. She had a power of attorney because, again, these companies will not, if you've got 2 different policies, all right, they're not going to, you know, an insurance company will not talk to me, you on the phone, and they typically will not talk to you about your wife or your husband's policy, even though you're married. They need them on the phone to approve that unless we are, or unless paperwork is submitted to have us as agent of record. Okay.
I understand that. All I'm asking you is if the paperwork is proper, et cetera, are you finding the companies are still dragging their feet?
I haven't really experienced that. I mean, there is paperwork to be done. All right. And the clients that I've worked with, even if they're not our insurance client, just individuals who have policies that know about me, reach out to me. The companies do pay the claims. I will share this with you. I recently, just last year, had an experience where I worked with a family up in Orlando. And they happened to have a John Hancock policy. Both mom and dad had John Hancock policies. Dad took ill. John Hancock approved the claim, began paying benefits right away, you know, once the elimination period was met. Mom then took ill about a year later. Dad had passed away. Mom was actually at the time not in as good a shape as dad was. John Hancock denied the claim. Family got frustrated, went back and forth with John Hancock. They got to me. And I helped the son craft various letters and gather up all the documentation for John Hancock. And what happened is we appealed. It did take about 2 months of appeals, took a lot of paperwork. All right. John Hancock said, we've made an error. We do honor this claim. And what's more interesting is mom had since passed away. And they wrote a check to mom's estate for $72,000. Again,
just to expand on that, so Mitchell, that is one of the services that you provide, is to help people if they're struggling with some of the paperwork or helping them with their claim. I know you charge a fee for that, but you can help people, and you do.
Yes, we do that by the hour. We do simple policy reviews for $295 for the first policy. Each additional policy is $99. If you just want us to come in, we'll have a review. We'll make a call to the insurance company together. We'll request an in-force illustration. If there are modifications that begins to become evident that they're prudent to make, be it for a long-term care policy, a life policy, whatever, then those would be by the hour. But the initial, just here's what you've got, let's make a phone call, and make sure that your questions are answered. We just do for a flat fee.
Okay, thanks. I'm going to withhold the second question in case other people have it because it's more specific.
There is a question about any comments about CNA policies?
So CNA was one of the first issuers of long-term care policies. Their contracts go all the way back to 1965. CNA actually filed for bankruptcy a number of years ago, but they are still paying their claims. Those monies are handled via a safe harbor clause. They reorganized. And so I wouldn't be too worried about CNA. And they're also, for those that might have annuities, CNA is still making their monthly annuity payments or annual annuity payments to people.
Great. Okay, well, thank you very much, Mitchell. It's great seeing you. Anybody else have any other questions? Want to raise your hand or anything?
If they
Yes,
don't,
I do.
oh, go ahead.
Okay, go ahead.
Hi. So my name is Brittany. I'm with Next Stage Care that Barry was with. And I have a question. As a younger person, my mother just turned 60, and I was thinking about getting a long-term care insurance policy on her just because she doesn't have anything like that lined up. Is that something you're finding younger people like myself are doing for their parents? And is it too late at that stage for her to get long-term care insurance?
At age 60 is still young. At least it better.
Okay.
I'm 63. All right. So I like to think of 63 as not necessarily being old, although I have my days. But we do indeed find that sons, daughters, we're going to buy a policy because very candidly, if they don't, it's going to potentially fall on them.
Exactly.
And so it's a way of protecting mom, but more importantly, it's a way of protecting yourself. Because I'm just going to tell you this, my mom is 90, mom is in a community. My brother lives 1,600 miles away in Framingham, Massachusetts. He and my mom have never really gotten along, to be very candid. I'm here. Scheduling my mother's doctor appointments, transporting her to get her nails done every now and then, get her cut once a month, taking her for her retina injections, for her kidney doctor, okay, et cetera, et cetera. I'm just going to tell you, typically take between 10 and 15 hours a week that I am helping my mom. Now, I will also say this. My mom was a great mom. My brother would disagree, but that's shared. I look at it as, well, mom held my hand for years. It's now my turn to hold hers. I'm also going to tell you this. There are days it becomes incredibly frustrating. I sometimes lose it. I'm not always the kindest son. It's like, Ma, what are you doing this for? Okay, I don't have all the tools in the toolbox to be always in control with my mother. I tell you, I am so thankful that she bought that long-term care policy because it would just be like, because candidly, my mother has spent through her money over her lifetime. Okay, plain and simple.
And conversely, there are times, Mitchell, that people, parents might buy a long-term care policy for their kids.
Yes, I have a number of clients who have done insurance plans for their children or their children, because there's one joke, Mitchell, if something happens to one of them, you know what? Guess who they're calling? By me taking care of the kids and they're younger, gifting anyway. So now we're just going to say, look, we're going to pay for your insurance. All right. You know whose retirement we're protecting? And life now, we're protecting ours. And this gentleman was, I said, yeah, I said, that's because he said, look, we're going to self-fund. We're not going to worry about this. We've done okay. We're a little bit worried about the kids. And I said, look, I think you're being smart. And it was actually my suggestion to maybe do something for the kids. I said, this way their mortgages would be covered. If they were disabled, they bought modest disability policies, modest term life policies, modest long-term care policies. And I said, this way their mortgage will be covered. And that, husband looks at me and goes, Mitchell, I hold the mortgages on all 3 houses for each of the kids. Guess what? They're all healthy and working. You know what? They pay my mortgage now. Okay. He goes, I doubt they're going to pay it if something happened, but that's why we're going to have this policy.
So Mitchell, thank you very much. If you all have specific questions for Mitchell, I'll be sending everybody out a recorded version of today's webinar with Mitchell's email. So feel free to email Mitchell, call him if you have specific questions about your policy. I'm sure he's happy to help you through that.
Yeah, and Bruce, please feel free to share my cell phone. I mean, I love what I do. I pretty much do it 24/7, 365. Give me a holler. Hey, Mitchell, I got a quick question for you. Or, can we set up a policy review? Always happy to be a resource. And I work for you. So if it's a Sunday afternoon, if it's a Thursday evening, whatever works best, we are here.
Well, you're going to have to take out Boris sometime. So hopefully.
You're right.
So great to see everybody. We're gonna end it here. And again, if I could be of any help to anybody, reach out to me. I also love your referrals. I know a lot of people, tell their friends about what I do and the services that I offer. And so I really appreciate that as well. But great to see everybody. And, it's kind of crazy that this time last year we were all masked up and now things are lightening up. So it's nice to see things are getting back to normal. I do have a number of events coming up that I'll be sharing with you all. Our next webinar will be June 10th, and I have Marla Ottenstein, and we're going to talk about hurricane preparedness, which is a hot topic for June, because June 1st is hurricane season. So she's great, and she packs a lot of good information into our presentation. So you all should be part of that. And great to see everybody, and stay well. Thank you very much, Mitchell. You've done a great job.
Thank you, Bruce, and thank you everyone for participating.
All right.
Thank you, Mitchell.